This tutorial deals with the concept of value at risk. This is the value at risk dashboard for Jim's sample. It calculates the value at risk for Jim's vested options and owned shares. These values convey the inherent risk in holding company stock and vested options. This dashboard enables users to revise the relevant assumptions and compare results in tabular and graphic formats. Let's begin by reviewing the concepts on which VaR Dashboard is based. Value at risk is a statistical method of measuring risk. It was developed by banks to evaluate the overnight risk inherent in their portfolios. Value at risk is based on the concept of log normal distribution, which we will cover in the following slides. It measures how large a loss might be when incurred due to market risk over some selected time frame and given a selected confidence level. The assumptions involved in the value at risk calculation are market risk factor, or stock price volatility, as is used in the Black-Scholes value calculation. The time frame involved. The calculation here looks out 30 days, and the confidence level. We use 95%, or put the other way, there is a 5% probability that the stock price will decline. Log normal distribution methodology is used due to two main limitations inherent in the use of normal distribution methodology in this application. Normal distribution is usually illustrated as a bell curve with half of the probabilistic results below the current value and half above. The problem with the application of normal distribution to the measure of possible stock price movements is that it does not take into account that stocks trend upwards over time and that the price of a stock cannot go below zero. Log normal distribution successfully addresses these issues. After selecting the probabilistic price 30 days out at the 5% level, StockOpter.com then calculates the in-the-money value of the current portfolio of vested options and owned company stock based on that price. That value is then subtracted from the in-the-money value of the current portfolio of vested options and owned company stock based on the current price. The difference is the amount of current portfolio of vested options and owned company stock based on the current price that would be lost over a 30-day period with a 5% likelihood. On the other hand, there is a 95% likelihood that the portfolio could lose less than this amount or could gain value. This is the figure that is referred to as value at risk in StockOpter.com. The value at risk in StockOpter.com is the loss that would occur if the stock price today were to instantly change to the 5% probability of the possible decline in prices 1 month from now. The Total VaR Dashboard calculates the value at risk amounts for Jim's vested options and owned shares based on the current stock price and volatility assumptions. These values represent the potential loss during the next 30 days under normal market conditions using a 5% probability. The revised values table can be updated by modifying the stock price and volatility assumptions using the sliders or input boxes. Changes in price or volatility will produce corresponding increases or decreases in the VaR values on the revised table and graph. For example, if we increase the volatility from 35% to 50%, the value at risk amounts increase as well. In conclusion, the VaR dashboard provides users with a means of quantifying and modeling the potential risk of holding owned shares and vested options, which can be useful information in their decision process. This concludes the tutorial.